Hello, I'm Tony Proctor, enrolled agent with Proctor & Associates Tax and Bookkeeping. Today's tax tip, we're going to talk about deductions. Standard versus itemized deduction. The typical taxpayer is going to have about this amount in deductions. For tax year 2013, that amount for a single taxpayer is $6,100. For a married filing joint or qualifying widow or widower with dependent child, that amount is going to be $12,200. And then for head of household, the standard deduction is going to be $8,950. You notice that there is no standard deduction for married filing separate. Well, married filing separate, if that's the filing status that you guys chose, both of the spouses are going to have a standard deduction of $6,100, what the single deduction is. However, if one spouse opts to itemize, the other spouse will be required to itemize as well. That could, kind of hurt your particular tax situation, but if you saw the episode on filing statuses, you'll understand that married filing separate kind of is the least beneficial way. Usually married filing joint is the way to go. And so now let's talk about itemized deductions. Itemized deductions means exactly that. You're itemizing and listing out all of your expenses. So if you have large out-of-pocket medical and dental expenses, income taxes that you've paid, whether you've actually paid income tax through withholding or you've made tax payments to your particular state. Also, taxes that you paid on your home. So if you're a homeowner, your real estate taxes. Also in that list of itemized deductions will be your mortgage interest. So interest that you paid on your mortgage, you should receive a form from the lender saying that you've paid X amount of dollars in mortgage interest for the year. Another item that's part of itemized deductions is going to be charitable contributions. So cash, if you've made cash contributions to church or various community organizations, that amount is included. Also, if you've made non-cash contributions, so you've made donations to Goodwill or some additional community resources, that amount is included in there as well. And then the final part of itemized deductions are miscellaneous deductions. They need to be over 1% of your adjusted gross income, and that's going to be tax preparation fees, investment expenses, safe deposit box. There's a number of items that are in that miscellaneous deductions. Again, it's based off a percentage of the AGI, so sometimes you can, that number will help you, but for the most part, sometimes miscellaneous deductions really don't do you so well, and that's kind of why IRS calls it miscellaneous. So that is standard versus itemized deductions. So that's today's tip, talking about deductions, standard versus itemized. I know that's another one of those areas where things are not so clear, so hopefully I was able to provide some information to you about standard versus itemized deductions. If you have any questions about today's episode, please log on to blackgirlinstruct.com, find my profile, and ask your question. And remember, only you can prevent an audit.